So in our last class, we started adjusted present value, and I was able to explain the underlying concept of APV. And we said today we are going to do purely calculation. We can't solve more than one question because it takes time. Not only that, we still have a lot to cover. And so, uh, after we are done with the illustration that we want to solve, we can then proceed to risk and uncertainty. All right. So in our last class, I explained what APV is all about and when you should calculate the adjusted present value. I said adjusted present value and then the net present value are similar. The same way the examiner will structure the question is the same for the two of them, for APV and net present value. The only thing that make APV to be unique is if in the question you are given issue cost or subsidized loan. Because oftentimes examiner will not tell you to evaluate using adjusted present value. You may be asked to assess. Examiner can ask you to evaluate or determine financial viability of a project. So in that case, you can either use, in most cases, it will be NPV. But if in the question, you can see issue cost or subsidized loan, then it means that it is adjusted present value examiner wants you to calculate, because net present value does not consider itself with method of financing a project. It has nothing to do with issue cost or subsidized loan. So it's only APV that considers issue cost and subsidized loan. So this is a little thing or a unique feature of adjusted present value. Okay. I explained the procedures that you need to carry out anytime you want to calculate adjusted present value. I gave you 4 different steps. The step 1 is to calculate base case NPV. All right, you calculate base case NPV. Then step 2, you calculate PV or financing effect cash flow. Then step 3, you calculate adjusted present value. Then step 4, you advise whether the project is financially viable. Okay. Of course, like I demonstrated for you last week, each steps, especially step 1 and step 2, all right, they have their own underlying procedures that you're supposed to carry out. When you want to calculate base case NPV, there are procedures you are supposed to carry out. When you want to calculate present value of financing effects, there are specific steps that you need to carry out. So all of this, I demonstrated it for you last time. So without wasting more time, let's go straight to solving a question. Again, like I said, we can't solve more than one because APV is always a very big one, and at the same time is kind of a technical. All right, it may throw you off balance, but if you take your time, if you master the procedures I've given you, the way we are going to be solving this question, if you master it, anytime you see question on APV, you won't be it won't be long before you solve it correctly and then move to the next one. All right. Don't be scared. APV is not difficult, only that you need time to master the procedures. Okay. All right then. So the last time ICAN tested adjusted present value was in 2019. Ever since then, we've been anticipating ICAN, okay, to try it again. All right, but we don't know the reason why. You never can tell. Maybe this is the time. Maybe this diet is the diet that ICAN will test it. Therefore, uh, again, just do your best. Ensure you cover the syllabus A to Z, irrespective. All right. So that is what I will have for you. All right. So let's solve this illustration number 2. It was tested November 2019. All right. Of course, anytime ICAN test APV is always a compulsory question. Okay? All right. So I need one of you to help us do justice to the question and read it. Who will take the lead? Who will help us to read quickly? Yes. Since beginning of this class, some of you have not spoken. You have not read anything since we started in July. Some of you have not read anything. In fact, you have not even spoken at all in this class, which is not good. I can't be pointing pointing names. Okay, you have not done this, but that notwithstanding. Let's move on. Who is helping us? Otherwise, I will choose one of you now. I need somebody to read for us quickly. You are wasting time. Okay, let me look at you. Okay. Uh Umi has done so well. She has done so much in this class. Yes. Faith. Faith. Read for us, please. Faith. Okay. If faith is not available, let me try Damilola. Damilola, I think Damilola has read in the past, but Damilola, you can try. Please help us read. Damilola, Timileyin, please go ahead. Thank you very much.
Okay. Can you hear me?
Yes, clearly.
Alcantara Limited is an unlisted company based in Akure, Nigeria. Over the years, the company has been producing and selling agricultural support tools. AL is now considering the production and sale of yam powders. Although this is a completely new venture for AL, it will be in addition to the company's core business. AL directors plan to develop the project for a period of 4 years and then sell it for 24 million to a group of young investors. The government is excited about the project and has offered AL a subsidized loan of up to 80% of the investment fund needed at the beginning of the project, at a rate of 200 basis points below AL's borrowing rate. Currently, AL can borrow 300 basis points above the 5-year government debt yield rate. A feasibility study commissioned by the director at a cost of 5 million naira has produced the following information. The company can buy an existing suitable factory at a cost of 16.5 million payable now. 4.5 million is required now to buy and install the necessary plant and machinery. The company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. Unit selling price for the first year will be 3,750, but this will increase by 3% per year thereafter. In the first year, total variable cost per unit will be 1,800, but this will increase by 8% per year thereafter. In the first year, the fixed overhead costs will be 3.7 million, of which 60% are centrally allocated overhead. The fixed overheads will increase by 5% per year after the first year. AL will require working capital of 15% of the anticipated sales revenue for the year. At the beginning of each year, the working capital is expected to be released at the end of the fourth year when the project is sold. AL's tax rate is 25% per year on taxable profit. Tax is payable in the same year as when the profits are earned. Tax allowable depreciation is available on the plant and machinery in a straight line basis. It's anticipated that the value attributable to the plant and machinery after 4 years is 600,000 of the price of which the project is sold. No tax allow sorry. No tax allowable depreciation is available on the factory. AL uses 12% as its discount rate for new projects, but feels that this rate may not be appropriate for this type of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government's offer of a subsidized loan.
You don't do kind.
Please, you are disrupting my class. Please mute.
Issue
Go
costs
ahead,
are
Timmy.
4% of the gross finance required. It can be assumed that debt capacity available to the company is equivalent to the actual amount of debt finance we raised for the project. Although no other companies produce yam powder in the country, Cantona PLC (LC) produces cassava crushing machines using almost similar technology to that required for yam powder. CL's cost equity is estimated to be 14% and it pays tax at 28%. CL has 50 million shares in issue, trading at 2.53 naira each, and 40 million naira bonds, trading at 94.88 naira per 100 naira. And the 5-year government debt yield is currently estimated at 4.5% at the market risk premium at 4%.
Thank you
Required.
very much. Yeah,
Okay.
thank you very much. I appreciate Timmy Lane. Even though you are a bit faster, but that notwithstanding, we got you. All right. So in the requirement A, examiner is asking you to evaluate on financial grants whether AHL should proceed with the project. So examiner is asking you to evaluate. At this point, you will recall that when we had capital budgeting, when we calculated NPV, I mentioned that anytime an examiner asks you to evaluate, assess, or ascertain whether a project should be undertaken, all right, it's okay, Mr. Atlisa. Now, and I told you that the technique examiner is expecting you to use is NPV. Why? Because NPV is a technique that is consistent with the shareholders' wealth maximization objective. All right. So you will notice from this question, the same way we have been calculating NP, the same way the scenario, the question scenario is being structured under NPV is the same way this question is being structured. Now, here, examiner is asking you to evaluate on financial ground whether the project should be undertaken. So, if you are not particular, I mean, if you don't take, if care is not taken, you may likely mistaking this question for net present value. However, when Timileyin was reading it, he mentioned issue costs. Okay, he mentioned issue costs. He also mentioned subsidized loan. All right, which means that because APV, it is only APV that uses issue costs and then subsidized loan. We don't need subsidized loan or issue cost for net present value. So examiner is asking you to evaluate. That means you are supposed to calculate adjusted present value because you are given issue cost and then subsidized loan. If that is the case, to calculate APV, I said there are 4 procedures you are supposed to carry out. Step 1, you calculate base case NPV. All right. Step 2, you calculate present value of financing effect cash flow. Then step 3, you calculate adjusted present value. Then step 4, you advise whether the project should be undertaken or not. So these are the 4 procedures you are supposed to carry out anytime you want to estimate adjusted present value. And that's what we are going to do to solve this question. All the underlying concepts I explained to you last time in our last class, all those procedures, now is the time for us to put it into practice. So just pay attention, open to the material at your end, then watch the way we are going to be picking the variables one after the other. Yes, Timileyin, you raised and talk to me.
Okay, so I just wanted to ask again. The issue cost and subsidized loan, do they have to go together? Or if we see issue cost,
No. Any of
okay.
them can be given. At times, if you are given in a question, if you are given just issue cost, so at times you may be given only subsidized loan, no issue cost. In fact, at times, examiner may not give to you issue cost and subsidized loan. Yes, but examiner will tell you calculate APV. So if you are not given issue cost, we are also not given subsidized loan, you are going to see interest in the question. interest will be given to you. So that means you only need to calculate present value of tax saved on interest. So you don't need to do for issue cost and then subsidized loan. But if in the question you are not given issue cost, you are not given subsidized loan, and the examiner did not tell you to calculate APV, then it has to be net present value. All right. So that's for that. Then let's move on. Let me stop sharing this and move to the working note quickly. Okay. All right. So the name of the company is Alcantara. This is solution. So illustration 2. I think that's page 55. Page 55, yes, I think. Yeah. Okay. 55. Now, examiner only asks you to evaluate on financial ground whether the company should proceed with the project. So in this case, we have identified from the question that we are supposed to calculate adjusted present value. Why? Because we are given issue cost and then subsidized loan. So if that is the case, to calculate adjusted present value, the name of let me put it down first. The name of this company is Alcantara PLC. No, Limited. AL. Okay. So the first thing you are going to do, since we have identified that we want to calculate adjusted present value, the first thing you are going to do is to calculate base case NPV. I will then say calculating base case net present value. Okay. Let's restrict our figures to million. So we then go to the question. What's the useful life of the project? Examiner told us 4 years. Okay, the useful life of the project is for 4 years. And not only that, we also need to go back to the question and check, when are we supposed to pay tax? Is tax paid in the current year or in arrears? According to the question, examiner told you that tax is paid 1 year, tax is paid in the current year. Okay, tax is payable in the same year as when the profits are earned. So there is no need to extend. So I will then do year 0, year 1, year 2, year 3, year 4, then additional column for workings. Okay. So based on our formats, anytime you want to calculate NPV, it's the same columnar format. So I will then come here, sales. Now, like I explained to you last week, whenever you want to calculate base case NPV, the same way you normally calculate the NPV is the same way you are going to do your base case NPV. The only difference is just that instead of you to discount the net cash flow using the company's WACC, you are supposed to use cost of equity loan geared. All right. So we go to the question, are you given sales value? Is there any inflation? Is there any taxation? Okay. Are we given working capital? Do you have scrap value? So all those things that you normally do for calculating NPV is the same thing. All right. So we want to determine sales value. So let's go back to the question and identify the selling price and then inflate it if any. Okay. So let's go open to the material at your end. All right. Okay. So we are starting from the additional information. So in the question, in the second paragraph, you are told that a feasibility study commissioned by the directors at a cost of 5 million naira has produced the following information. That 5 million naira is a sunk cost. It's not relevant. Visibility study cost is not relevant, so we ignore it. The first bullet point, the company can buy an existing suitable factory at a cost of 16.5 million naira, payable now. Okay, that's initial outlay. Initial outlay is 16.5. Then the second bullet point, 4.5 million naira is required now to buy and install the necessary plant and machinery. That's another initial outlay. So you add the two together. That will give you the total outlay. Okay, so let's say this first page is for my base case NPV. The second page is for present value of financing effects, including the third page. Let's see, let's go to the fourth page for our workings. So here will be for our workings. Hopefully, those 3 pages will be sufficient to answer the question correctly. Okay, so working number 1. What we are looking for, let's forget about the initial outlay for now. We want to calculate the sales value. We want to determine sales value based on the format. I will then go to the question. If you go to the third bullet point on page 56, you are told that the company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. So what the examiner is simply telling you is that, okay, the units produced and sold will be 1,300 in the first year. So from the second year up to the third year, these units sold will increase by 40%. But in the final year, which is year 4, instead of increasing by 40%, it will fall to 5%. So in this case, I will come here, units. Okay, I want to determine units. First thing first, I need to indicate the years. So we have year 1, year 2, year 3, then year 4. So units. Unit for the first year is 1,300. C, this is professional level. And you know that examiner has told you that your unit will increase by 40%. You don't need to be doing primary school kind of calculation. This is what you are supposed to do. Let me show you. Now, the first year unit is 1,300. And you know, as I've already explained to you, whenever you are given first year price, inflation should start from year 2. That is, you don't inflate the first year price. So in this case, we are given units, not even price, but this is first year unit. And we are told that we increase by 40%. Therefore, I will just say 40% plus 1 will give us 1.4. Therefore, 1.4 multiplied by 1,300. That's 1,820. Year 2 is 1,820. We are told that the third year will also increase by 40%. Therefore, 1,820 multiplied by 1.4. That will give us 2,548. 2,548. Then we're now told that before falling to 5% in the final year, so in the final year, instead of 1.4, it will be 1.05 because from 40%, it has fallen to 5%. So 2,548 multiplied by 1.05. So this will give us 2,675. 2,675. So with this, I have inflated the units produced and sold. So for the purpose of those not in this class, you may be struggling, except you are listening to the video, you may be struggling. How did I get these numbers? Yes. So alternatively, let me show you the primary school method. All right. So we want to determine unit. Unit for year 1 is 1,300. Just repeat it across board. So inflation, year 1, 1.04 raised to power 0, 1.04 raised to power 1, 1.0, sorry, 1.40, 1.40, 40 raised to power 2, okay, let me, raised to power 2, then this 1.40, that is raised to power 2 will then fall to 5%, so multiply by 1.05, okay. So with this, you should have the same answer. Anything raised to power 0 is equal to 1. So 1 multiplied by 1,300 will give us 1,300. Then 1.4 raised to power 1. Okay, then multiply by 1,300. So that will give us 1,820. Right? Then the third year, 1.40, then raised to power 2 equal, okay? Then multiply by 1,300 equal 2,548. Then the final one, okay? So 1.4 raised to power 2 equal, then multiply by 1.05 equal, then multiply by 13. That's 2675. 2675. Whichever one that is, easier, that is more convenient for you to follow it. I can't be doing these 3 steps when I can only do one. Easily, I will get the same answer. Why should I be stressing myself? Then, of course, working number 2 says, I want to determine sales value. Our sales are in million. Okay? So selling price, according to the question, let's go back to the question where we have selling price. You are told that unit selling price for the first year will be 3,715 naira, but this will increase by 3% per year thereafter. Okay? Now, examiner has given you first year price. That means inflation should start from year 2. Okay? Our selling price is 3,715 in the first year. So here is 3,750. Inflation rates, the inflation rate on selling price is 3%. Again, no need to be doing primary school. Primary school is school method is a waste of time. So I would then say 1.03. Inflation is 1.03 multiplied by 3,750 equal 3863. 3863. The figure you have in your calculator multiply by 1.03 equal 3978. What you have in your calculator multiply by 1.03 equal 4098. 4098. So with this, we have inflated the selling price. So the next we want to do is to determine sales. So let's say this is A, this is B. Therefore, we want to calculate sales. Sales is equal to A multiplied by B. So in the first year, 1,300 units multiplied by 3,750 equal. Our figures are in million. Okay, let's restrict our number to 1,000 since the figures are not really much. So 4,875. 4,875. So let's restrict our number to thousands since they are not much. Okay. All right. Then the second year, 1820 multiplied by 3,863 equal 7031. Year 3, 2548 multiplied by 3978 equal 10,136. 10,136. Okay. Then the final year, 2675 multiplied by 4098 equal 10,962. 10,962. So with this, we have calculated our sales value. Let's go and post it. Somebody was chatting. Oof. Oh, okay, Mr. Atlisa. It's all right. So 4,875 in the first year. Please be calling the numbers for me. I can't be switching. Here is 4,875. 7031.
7031.
Okay. Year 3,
10,136.
10,136, and then 10,962. Working number 2. So we are done with sales value. I will then go and calculate working for variable cost. So the same thing, the same way we calculated for sales. Working number 3, variable cost, total variable cost in thousands. Okay, so variable cost per unit, according to the question, in the next bullet point after the selling price, you are told that in the first year, total variable cost per unit will be 1,800 naira, but this will increase by 8% per year thereafter. So variable cost is 1,800 in the first year, 18. Inflation rate is 8%. Therefore, from my calculator, 1.08 multiplied by 1,800. That's 1944. What you have in your calculator, multiplied by 1.08 equal 2099.52. That's 2,100. What you have in your calculator, multiplied by 1.08 equal 2267. 2267. So with this, we have inflated the variable cost. Let's say this is C. Then to now get the total variable cost, it will be C, A multiplied by C. A multiplied by C. So 1,300 from the calculator, 1,300 multiplied by 1,800 equal, that's 2340. Figures are in thousand. 2340. Then for year 2, 1820 multiplied by 1944. 3538. Okay, 3538. Is it 353 or 3548? Let me check. Okay, 38. Yeah. So the third year, 2548 multiplied by 2100 equal 5351. Then year 4, 2675
6064.
6064. Okay. 6064. So let's go and post it. 2340. Year 1. So 2340. Then year 2 is what?
3538.
3538.
Year 3.
5351.
5351.
Then year 4.
6064.
6054.
Okay, then. So this is working number 3. I will then go back to the question in case I have any relevant fixed costs. Next to variable costs, we are told that in the first year, the fixed overhead cost will be 3,750,000, of which 60% are centrally allocated overheads. The fixed overhead will increase by 5% per year after the first year. Now, examiner has told you that the fixed overhead is 3,750,000 naira. However, 60% is centrally allocated. Central allocation is from head office charges. You can call that central allocation or central allocated overhead is simply the head office charges. Okay, so that means that 60% is not related to the project because any projects any cash flow that cannot be attributable to this project is not relevant. So 60% of the centrally allocated allocated overheads is not relevant. So we're only going to consider 40% of it. Therefore, let's work out the 40% of 3,750. Working number 4. Okay, fixed overhead. Okay, out of this fixed overhead, we are told that we have fixed overhead of 3,750,000. Figures are in thousands. So we are told that 60% is centrally allocated overhead. That means only 40% relates to the project. Therefore, 40% of 3,750 will give us 3,750 multiplied by 0.4. That's 1.5. Okay. 1,500. Only 1.5 relates to this project. 1.5 million. So I don't need to be working for inflation under this. I will just go straight because fixed overhead has nothing to do with units. So I will come here. Fixed overhead at inflation rate of 5%. Okay. The first year fixed overhead is 1,500. So examiner now told us that the inflation rate on the fixed overhead is 5%. Okay, so I would then say from my calculator, 1,500 multiplied by 1.05 equal 1,575. What you have in your calculator?
1634.
1634.
554.
16. Is it
54.
5? Okay, 1654. Then the fourth year,
1736.
1736. So working number 4. Now, After this, I need to go back to the question to check in case I have other relevant cash flow. Immediately after the fixed overhead, the next item is working capital. So working capital will come much later. At this point, we need to determine the taxable profits. So for year one, I would then say 4875 minus 3840 equal 1035. So this is profits. For year two,
1918.
1918. Okay.
31.
31. All right.
3162.
3162. So these are taxable profits for the relevant years. So immediately after profit, we are supposed to pay tax. I will then go to the question for Alcantara. What is the tax rate for Alcantara? According to the question, tax rate is 25%. A tax rate is 25% per year on taxable profit. Tax is payable in the same year as when profits are earned. So 25%. So at 25%. Therefore, 0.25 multiplied by 1035. That's 259.
480.
480. Okay.
783.
783.
791.
791. So immediately after tax, we are supposed to consider capital allowance. I will then go to the question, are we given capital allowance rates? So in that same paragraph, you are told that tax allowable depreciation is available on the plant and machinery on a straight line basis. It is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 naira of the price at which the project is sold. No tax allowable depreciation is available on the factory. Pay attention to this. In the first bullet points, on this additional information, you are told that the company can buy an existing suitable factory at a cost of 16.5 million naira payable now. You can't claim capital allowance on an existing asset because the original owner of that asset would have been claiming capital allowance, and capital allowance is not something you can transfer. All right. So the 16.5 million naira does not qualify for capital allowance. So in the second bullet point, you are now told that 4.5 million naira is required now to buy and install the necessary plants and machinery. So only this 4.5 million qualifies for capital allowance. Okay, and that's what the examiner is telling you in that particular bullet point where you have the capital allowance, that no tax allowable depreciation is available on the factory. All right. So what if whether this information is there or not, once you are given an existing asset, okay, once a company purchases an existing asset, you cannot claim capital allowance on it because that asset does not qualify. Therefore, let's go and calculate our capital allowance. Let's calculate our capital allowance in this case. Okay, that will be working number 4, 5. So since capital allowance is on a straight line basis, I don't need to waste my time. I will just come in number 5, working number 5. I want to calculate tax saved on capital allowance. Okay. First thing first, I need to calculate capital allowance. I would then say capital allowance equals, tax saved is calculated as capital allowance multiplied by company tax rates. So I need to first of all calculate capital allowance. So capital allowance is cost minus scrap value multiplied by, divided by useful life. Okay, divided by the useful life, because examiner has told us that it's on a straight line basis. Okay, so the cost of this machinery is 4.5 million. We are told that the machinery will be disposed of at 600,000 naira. So minus 600,000, then divided by useful life of 4 years. So annual capital allowance will then be equal to 3,900, 39 divided by 4. That's 975. 975 is annual capital allowance. That's not what I'm looking for. I'm looking for tax saved. Therefore, tax saved on capital allowance will then be equal to capital allowance multiplied by company tax rate. Therefore, 975 multiplied by 25%. What do we have here? Okay,
244.
244. 244. So that's annual tax saved. In the final year, because if you multiply 244 by 4 years, okay, it will give you 976. Okay, it will give you 97. That means you have claimed more than what you are supposed to claim, because your total capital allowance is 975. Your total capital allowance is 970. You can't claim more than that. All right. But if you multiply 244 by 4 years, it will give you 976. Therefore, the final year capital annual tax saved, you restrict it to 243. Okay. So let's go and indicate that. Tax saved on capital allowance. So capital allowance will follow the same pattern of your tax liability. Because tax liability is in the current year, then tax saved on capital allowance will also be in the current year. So it's a claim 244. Then the final year it will be 243. This is working number 5. After capital allowance, the next item will then be the scrap value. According to the question, we are told that the project will be disposed of. Let me look for that information. Yes, in the second paragraph, examiner told you that AHS director plans to develop the project for a period of 4 years and then sell it for 24 million naira to a group of young investors. All right, so scrap value for this project is 24 million naira. Out of the 24 million naira, 600,000 scrap value belongs to plant and machinery. And that's what examiner told you in that question, that it is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 of the price at which the project is sold. So the project is sold for 24 million naira. Out of the 24 million naira, 600,000 relate to plant and machinery. But we are looking for scrap value for the project, so it's 24 million. Our figures are in thousands, so here will be 24,000. Yes? OS Consulting, what's your question?
Sir, I believe maybe there was a network glitch from my end for some minutes, so I didn't get why it's 243 in the last year.
Your total capital allowance is 975. If you multiply 244, if you multiply 2244 by 4 years, it will give you 976. So you cannot claim more than the capital allowance you're supposed to claim. That's why we restricted the final year to 243.
Okay,
Is it clear now?
Yes, sir, it's clear.
Okay, then. So, according to the question, we have two different initial outlay. Let's go and do working for that. Initial outlay. Working number 5. Is it 5 or 6? 6. So initial outlay. So we are told that we have an existing factory that worth 16,500,000. Our figures are in thousands. Then we also have plant and machinery. Is it plant and machinery or plant and equipment? Let me confirm.
Machinery.
Plant and machinery. Okay. So plant and machinery. This one is worth 4,500,000. When you add the two together, that's 21,000. So that's our initial outlay. Okay. So here will be 21,000. It's a cash outflow. Okay. Next, after initial outlay, the next thing we want to do is to calculate working capital. So let's go back to the question. How do we treat our working capital? That will be working number 7. Working capital. For year 1, year 2, year 3, year 4, then total. So, according to the question, working capital, yes, you are told that AL will require working capital of 15% of the anticipated sales revenue for the year. At the beginning of each year, the working capital is expected to be released at the end of the 4th year when the production is sold. So working capital is 15%, of the anticipated sales revenue. Therefore, I would then say working capital at 15% of sales. So for the first year sales value is 4875. Therefore, 15% of 4875 multiplied by 0.15.
731.
731. Then year 2 sales is 70.
1055.
1055. 1055. Then year 3.
1520.
1520. Then year 4.
1644.
1644. So this simply means that the highest working capital, you can see that working capital has increased from year 1 to year 4. All right, so it has increased from 731 to 1644. That means the highest working capital is 1644. Now, because working capital has increased, you need to determine incremental working capital. So I would then say incremental working capital. The first year working capital is 731. 731 increased to 1055. I would then say 1055 minus 731 equal
324.
324. Again, 1055 has increased to 1520. What's the difference?
465.
465. 1520 has increased to 1644. What's the difference?
124.
124. 124. 1644 has increased to 0. So here will be 1644. So the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. The working capital at the end of year 1 will be treated as cash outflow in year 0. The one of year 2 treated as cash outflow in year 1. The one of year 4 treated as cash outflow, in year 3 treated as cash outflow in year 2. The one of year 4 will be treated as cash outflow in year 3. Then at the end of the useful life, you recover the entire working capital of 1644. So this is how we are going to treat the working capital. Yes, Victor, talk to me. What's your question?
Okay, sir. Sorry, sir. I just want to draw you back a little, right? This
Yeah.
the value of the scrap value used in calculating your tax save and that in used in calculating the base case MPV. I just want to ask, what is the difference between the two?
The what?
The scrap value, the 600 and the 24 million.
There is difference. Now, you know, in the question, the examiner told you that the project will be sold to a group of young investors for 24 million naira after the project is completed, right? So when you
Yes,
now
sir.
go further, where the examiner talked about capital allowance, you are told that the plant and machinery is 4.5 million and it will be disposed of after the project is completed. After in the final year, the plant and machinery will be disposed of for 600,000. The 600,000 included the 24,000, the 24 million. All right. So out of the 24 million naira, 600,000 of it is meant for plant and machinery. You get?
Okay, sir. Yes,
But
sir.
the project, the scrap value of the project entirely is 24 million.
Okay, okay.
Yeah,
Thank you, sir.
you're welcome. Somebody send the charts. The figure for year 1 is wrong. Okay. 15% of 4875. Charity, you said the figure is wrong. Which one is wrong? Or somebody, okay, somebody has, okay, you're not aligned, so no problem. Now, what's the second year working capital we computed? Minister of Finance.
The second year,
324.
Working capital.
324.
324. Thank you.
465,
465.
124.
Then 124. So that's that. At this point, we didn't get the net cash flow. Here is 21731. Net cash flow. Year 1, what do we have?
694.
694. Year 2, year 3, and then year 4. Let's keep moving. Time is
Year
flying.
2,
Yeah,
1,217.
217. Okay.
2468.
2468.
Twenty-eight 258.
Pardon? 28 258.
258.
Okay, then. Thank you. Now, pay attention, please. We just completed the first step of your base case NPV. The first step says you should determine the net cash flow. We have done that. The second step says you should calculate cost of equity on gear, because when you are calculating APV, when you want to calculate your base case NPV, you don't use the company's existing WACC. You have to use cost of equity on gear. All right. Okay. To do this, I will then go back to the question, how do I calculate my cost of equity on gear? I gave you three methods of calculating cost of equity on gear. I said if in the question you are given beta of a proxy company, that means you are supposed to follow 3 steps. The first step is to identify the proxy beta. Then step 2, you ungear the beta if it is geared. Then step 3, you calculate cost of equity on gear using capping. All right. So those are the 3 procedures you are going to carry out if you are given beta. But if in the question you are given cost of equity of a proxy, that means you are supposed to use Miller and Mondigliani formula to calculate your cost of equity on gear. Then the third way of calculating your cost of equity on gear is if you are given the WACC of a proxy company. When you are given WACC of a proxy company, then you are going to calculate WACC of on gear. And I said WACC of on gear is the same thing as cost of equity on gear. All right. So I will then go to this question. What kind of information of a proxy are we given in relation to those 3 items I mentioned? The name of the main company is Alcantara Limited. We have been given second bullet point, second to the last bullet point. We are told that although no other company produce yam panda in the country, Cantona Limited produces cassava crushing machines using almost similar technology to that required for yam panda. CS cost of equity is estimated to be 14%. So we have been given cost of equity of a proxy company. That means we are supposed to use Miller and Modigliani formula to calculate cost of equity on gear. Therefore, I would then say cost of equity on geared KEO. So to do this, we just use Miller and Modigliani. According to Miller and Modigliani, cost of equity of a gear is equal to cost of equity on gear. Let me write that. What's wrong with you? Okay, plus, open a bracket, cost of equity on gear minus cost of debt. All of this multiplied by debt value multiplied by 1 minus tax. 1 minus tax divided by equity value. Okay, so this is the Miller and Modigliani formula of calculating cost of equity. Yes, was consulting, what's your question? Quickly.
Sir, please, I need clarification on why the working capital at the end of the, I think year 4 is positive. I don't get why, sir.
You are recovering your working capital now. This is not the first time we'll be calculating it.
Yes, sir. Sorry.
We are recovering it.
Okay.
In the final year, you need to recover the working capital. When I was explaining the concept under capital budgeting, I said that incremental working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. So the one that occur at the end of year 1, okay? The working capital that occur at the end of year 1, which is 731, it should be treated as cash outflow in year 0. The 324 that occurs at the end of year 2 will be treated as cash outflow in year 1. The one that occur at the end of year 3, 465, will be treated as cash outflow in year 2. The one that occur at the end of year 4, which is 124, will be treated as cash outflow the year before year 4. Year before year 4 is year 3. Then at the end of the useful life, you recover the entire working capital. It's a recovery. Your working capital must be equal to 0 at the end of the day. So the highest working capital is 1644. That is what you are going to recover. Do you get it now? OAS Consulting.
Yes, I get it now.
All right then. Uju, what's your question?
Please, for year 1, net cash flow is 696, not 694. Before we go further.
696.
Yes, sir.
Okay. Let me check. Okay, 69644. Okay, it's possible. 5. It should be 694. This one is 259, not 257. Oh.
Yes, sir.
1035. Let me confirm. 1035 minus 259 plus 244 minus 324 equal 696. You are correct. It's 696. Thank you. Okay then.
Okay.
So we need to go and calculate our cost of Ufoma, what's your question?
Sorry, also for the when we are calculating tax save on capital allowance, are we not supposed to get at the end of the life of the assets? Are we not supposed to calculate the balance allowance also, because we're given a disposal value?
We are not using primary school method this time around. Examiner say your capital allowance on a straight line basis. To get the straight, that is the same amount every year. To get the straight line basis, which already the cost of the asset minus scrap value divided by the useful life every year, whatever you have, 975 is what you are going to claim as your capital allowance. That's what we have done. If you want to use that primary school method, you are still going to get the same thing, but you don't need to do that for now. All right? Ufoma.
Okay, sir.
Okay.
Yes, sir. Thank you.
So we are looking for cost of equity on gear. So we don't have it. So here will be cost of equity on gear plus cost of equity on gear. We need cost of borrowing of the proxy company. According to the question, when you go to where you have information of Cantona PLC, okay, it's Cantona Limited. So when you go to where you have information of the proxy company, Cantona, all right, you are given a bond. You are given bond of 40 million naira. That bond, what is the interest rate on the bond? The interest rate on the bond is not given to you. So where cost of borrowing is not given, you are going to assume risk-free rate of return. Okay, you are going to assume risk-free rate of return as your cost of debt since it is not given. And according to the last bullet point, you are told that the 5-year government debt yield is currently estimated at 4.5%. All right, so risk-free rate of return is 4.5%. So that's what you are going to use as your cost of debt, because cost of debt is not given for the bonds. Okay, so I would then say 4.5. Here is 4.5. Okay, then multiply by, I need debt and equity value of the proxy company. It's not given to us, so we need to go and work it out. Debt and equity value. Okay, that will be working number 9. Working number 9, I want to calculate market value. Okay, so equity value denoted as E is calculated as share capital, or in the question, are we given number of shares? Let me check. Yes, we are given number of shares. So no need to use share capital since we are given number of shares. So I would then say number of shares multiplied by share price. So in this case, for CL, for Cantona, before that, let's put the formula for debt also. So for debt value, D, debt value is calculated as nominal value multiplied by market price of the bond divided by 100 naira. Debt is quoted at 100 naira per unit. So these are the two formulas we are going to use. So equity value will then be equal to number of shares. The bond is 50 million shares. Our figures are in thousands. Therefore, or let me just write it out in full. 50 million shares multiplied by the share price. The share price of Cantona is 2 naira 53 kobo. 2 naira 53 kobo. 2.53. Therefore, what do we have here? So 15 million multiplied by 2.53 equal 37,950. 37,950. So that will give us the equity value of Cantona. Okay, I did not put Cantona here. Then the debt value of Cantona. Debt value is nominal value multiplied by market price divided by 100 naira. So according to the question, the debt value of that bond, okay, the nominal value of that bond is 40 million naira. All right. And we are told that the market price is 94 naira 88 kobo per 100 naira. So 40 million, here is 40 million naira. Multiplied by the market price of 94.88 divided by 100 naira. So 40 million multiplied by 0.9488 equal 37952. 37952. So that's the market value. Therefore, I need to go and I'll then continue with this. Debt value is 37952. 1 minus tax. What's the tax rate of the proxy company? The tax rate we are told is 28%. The company pays tax at 28%. So 28% minus 1 minus 28% will give us 0.72. Then divided by 37,950. So here will be 14 equal to KEU plus, open a bracket, KEU minus 4.5, then 37952. 37952 multiplied by 0.72 equal, then divided by 37950 equal 0.72 multiplied by 0.72. So let's expand. Here will be 14 equal to KEU plus 0.72 KEU minus 0.72 multiplied by 4.5 multiplied by 4.5.
3.24.
So that's 3.24. 3.24. You then collect like terms. Before that, I have 14 equal to KEU is 1. When you say KEU is 1, so 1 plus 0.72. This will give us 1.72 KEU minus 3.24. Then you collect like terms. So in this case, I don't have space again. So let me just manage it. So in this case, I would then say 1.72 KEU equal to 14 plus 3.24. So this will give us KEU will then be equal to KEU will be equal to 1.72 divided by what do I have there? Divided by 17.24 rather. 17.24. Is it 17.24? Yeah.
Correct.
17.24 divided by 1.72. So
10.
this will give approximately 10%. Okay. So cost of equity on gear is 10%. So I will then come here. 10%. Here is 1.909 826 751 751 683. This is working number 7. Then we get out the present value. Okay. So here will be 21731. Okay. So 696 multiply.
633.
Okay. 633. 633. Here is 633. Next one.
1049.
1049.
1853.
1853. Here 4.
19300.
19300. So add everything together and the minus 21731. What's our base case NPV?
One 1104.
1104. 1104. That's not correct. Are you sure?
1060.
1060. You are correct. That's the answer. All right. So we have completed one part, which is base case NPV. The second part is step 2 is to calculate present value of financing effects. Okay. So step 2. To
Excuse
get the
me,
present.
please. Excuse me.
Who is speaking?
Please, this under year 2, if you cross-check this value 1049, I'm thinking it should be 1005. 1217 times 0.826
Yeah.
is 1005.
1005. Okay.
Yes, 1217 times 0.826.
Let me check. 1217
It's correct.
multiply
1005.
0.826.
1005.
1005 is the answer. Okay, so that 1217, is it correct? Okay, maybe that's why you are getting a different answer the other time. Anyways, cross-check your answer, but I know this 4016 is correct. All right, so cross-check the answer to be sure.
It's correct now.
Okay then.
1060.
Okay then. Now we want to calculate the PV of financing effect cash flow. Step 2. Calculating PV of financing effects cash flow. So to calculate the PV on financing effect, there are 3 components that make up the financing effect: issue cost, subsidy, as well as interest. So it's not compulsory that you may have the 3 of them in a question. Anyone that you have is what you are going to calculate for. So in this question, we have the 3 of them. All right, we have the 3 of them. We have issue cost, we have subsidized loan, and we also have interest. Therefore, I can then calculate my PV. I need to go and calculate PV of issue cost. I will calculate PV of net subsidy. Then finally, I will calculate PV of tax saved on interest. So this will then give me the PV of financing effect cash flow. Okay. So let's go and work it out. So we want to calculate PV of issue cost. All right. That will take us to working number 10. Now, I explained to you, whenever you want to compute PV of financing effects, you need to decide whether you want to use gross finance required or net finance required for the cash flow arising from net subsidy and tax saved on interest. And I advise you that at all time, always use the gross finance required, except examiner says otherwise. In most cases, examiner will ask you to use gross finance required. However, in this case, to calculate the gross finance required, you are going to divide you are going to divide the initial outlay plus working capital. You divide it with the 1 minus issue cost rate. So because of time, all right, because of time, let's solve that. We want to determine gross. Before gross, we need to determine net finance required. NFR. So remember when I was explaining to you last time under this, I said that the amount that the company will receive at the end of the day will be the net amount, because when you want to borrow in the market, you want to raise capital in the market, you are going to incur some expenses before you receive the funds. So you are going to incur some expenses. Those expenses are what we call issue cost, like registration fee, usually paid to Security and Exchange Commission. All right, the investment banking fee that the company will pay to the investment banker. All right, is part of the expenses. Of course, for example, the company will also incur marketing expenses. The company will incur marketing expenses. Not only that, professional fee will also be paid. All right, professional fee will be paid to the auditor, because the financial statement of the company will need to be audited. Not only that, the company will also incur legal fee that will be paid to the lawyers that will review the company's document for the purpose of raising the capital. So all these expenses are preliminary expenses. They are issue costs. So they will occur at the beginning before the company receives the required amount. So those expenses will be incurred, and those are the expenses we call issue cost. Therefore, the net amount is what the company will receive at the end of the day. So to now gross it up, all right, first thing first, I will then say this net finance required. So what the company has received is the initial outlay required for the project. Initial outlay, okay, plus any working capital. If you are given working capital in the question, then your working capital in year 0 is part of the finance required. So working capital. So it is only working capital in year 0 because it is believed that any cash flow generated by the project will be used to finance the working capital going forward. Okay, after year 1, any working capital incurred by the business will be financed through the internally generated funds. Okay, all right then. So according to our calculation, the initial outlay is 21,000. Working capital is 731. The two of them is 21,731. So that's the net finance required. So to now get the gross finance required, GFR. So the gross finance required will be calculated as net finance required over 1 minus issue cost rate. So according to the question, issue cost rate is 4%. Therefore, 21731 over 1 minus 0.04. What do we have here? This will give us 22,636. Please confirm if that number is correct. Okay, I believe it's correct. All right. So, again, working number 13, we need to decide if you want to use cost of borrowing or risk-free rate of return, because according to Miller and Modigliani, now, Miller and Modigliani are the two controversial guys that deploy the adjusted present value, but they fail to tell us the discount rate to be used for cash flow arising from financing effect. Therefore, you are at a liberty to either use cost of borrowing or risk-free rate of return. And I advise you that always use cost of borrowing. Why? Because cost of borrowing is always higher than the risk-free rate of return. Therefore, to now determine the cost of borrowing rates, this borrowing rates it is borrowing rate for Alcantara, not for the proxy company. Okay? So according to the question, let's go back to the question where we are given information on borrowing rates. There's a place examiner mentioned that the company can borrow. Yes, in the second paragraph, last statement in the second paragraph, examiner told you that currently, AHE can borrow at 300 basis points above the 5-year government debt yield rate. 300 basis points is the same thing as 3%. When you are given a basis point, just divide it by 100. So it will give you the percentage. Therefore, borrowing rates, that is normal borrowing rates, we are told is 300 basis points. Okay? So 300 basis points is equal to 300 divided by 100 equal to 3%. All right, multiply by 100%. So this is 3%. Therefore, the normal borrowing rate will then be equal to, we are told that it's 3% above the government debt yield rate. Government debt yield rate, which is the risk rate of return, is 4.5. So 3.3% plus 4.5%. This will give us 7.5%. Okay, so that is the cost of borrowing. Then, at this stage, what else am I looking for? I want to calculate issue cost, okay? I think I have a space. I've estimated space before for this issue cost of a thing. Okay, let me use this will be for APV will be somewhere here. So let me use this one. I stop at which working is this one because I don't want to. This is page 1, page 2. Okay. We want to calculate PV of issue costs. Let's use here. Okay, with assumptions. Okay, let me just go to the last so that I don't squeeze myself for space. Let me just come here. 14. I want to calculate PV of issue cost. PV of issue cost. Okay, to calculate the PV of issue cost, I gave you 3 procedures. Step 1 is to calculate issue cost amount on equity and debt. In this question, we don't have equity. It's all about debt. Okay? It's as per debt. We don't have equity. Therefore, I need to calculate issue cost amount on debt. I will then say issue cost amount ICA on debt. How do you do this? Okay, let me write this clearly. On debt, to calculate issue cost amount, we are supposed to multiply the gross finance required with the issue cost rates. Okay, so in this case, gross finance required is 22,636 multiplied by issue cost rate on debt is 4%. So this will give us what? Minister of Finance, are you still there?
905.
905.
Yeah.
That's correct.
Okay. 905 is the issue cost. All right. Then step 2 says
That's
you should
working
calculate
13.
14. Oh,
The other
okay.
one is 2.
This one's supposed to be 12. So 12, 13. Yeah. So the second step when you are calculating the PV of issue cost is to determine the PV of issue cost now. Okay. PV of issue cost in year 0. PV of issue cost amount. Issue cost amount in year 0. How do you do this? PV will then be equal to the issue cost amount multiplied by the discount factor at year 0. Okay, at year 0. Remember, anything you want to do, we have already decided that we are going to use borrowing costs as our discount rate for financing effect cash flow. So any PV you want to calculate under the financing effect, you are supposed to use the borrowing rate of 7.5%. Okay, so whatever you want to do must be at 7.5%. Okay, therefore, PV in year 0 will then be equal to 905 multiplied by discount factor in year 0 will be equal to 1. That is 1.075 raised to power 1. So it will give you the same amount. This is equal to 905. All right, this is 905. It should be in brackets because it's a cost. It should be in brackets. Then step 3, you need to calculate PV of tax saved on the issue cost amount on debt. Okay, PV of tax saved on issue cost amount on debt for year 1 only. So how do you do this? PV of tax saved will then be equal to issue cost amount on debt, ICA on debt, multiplied by discount factor of year 1. The discount factor of year 1 at 7.5%. Okay, so this is equal to 905 multiplied by a discount factor of 1.075. Sorry, this one is raised to power 0. Yeah, 0. Then this is raised to power 1 of year 1. What do we have here? 1.90, sorry, then multiply by, this is not complete. You know, we are calculating tax saved, so you need to multiply with the company tax rates. Okay, then multiply by, the company tax rate is 25%. Therefore, this will give us 905 multiplied by
243.
243. Okay. So, are you sure it's 243?
Yes, sir.
Okay, let me try and see. Where's my calculator? So here is okay, 1.075 raised to power 1 equal error 1.075 raised to power 1 equal, okay, multiply by 905 equal, multiply by 0.25 equal, you are correct, 243. So finally, I now need to add the two together. So PV of issue cost will then be equal to 905. You know, now 905 is a minus, okay, plus 243. So this will give us what? Okay, that's 69. Let me see.
Minus 662.
Minus 662. And something is wrong somewhere. Something is wrong. This is not correct. What's the company tax rate is 25%.
Okay, it's 28.
No. The company tax rate is 25% for Alcantara. Let me see. So the company tax rate is 25%. Okay.
Yes, 25.
So let me see. Year 1, 7.5. 7.5.
The discount factor is not supposed to be raised to power minus 1.
The
So
issue,
that's where the
It's supposed to be raised to power minus 1.
yes, discount factor is supposed to raise to -1. You are correct. Thank you very much, Jara. Because that
Thank
number
you.
is strange to me now. So you are correct. So in this case, you know, 1.075 raised to power 1 minus
excuse me.
equal then multiplied by 0.25 equal multiplied by 905 equal, that's 695. Sorry, what am I doing?
So be
What am I
210.
doing? 210, yeah.
Yes,
210.
210.
210. This one's supposed to be 210. So 210 minus 905 will give us 695 negative. Yeah, you can imagine. Common discount factor. You know, when you're on the on the D-Day, you'll be happy that you are working fine, but you don't know that you have committed error somewhere. You can see, I'm looking for discount factor. Meanwhile, I'm compounding instead of discounting. You know, but that number is strange to me. Like the same question I solved yesterday. This is not the same thing. Now, what is happening? Not knowing that I did not discount it. But in any case, so that's our issue cost. So I will then go up there where you have the PV of financing. I will go and put 975. Sorry, 695. So here will be 695 negative. So we need to go and calculate PV of net subsidy. To calculate PV of net subsidy, we have 4 procedures you are supposed to carry out. That's working number 14 now. Okay, working number 14. PV of net subsidy. You only calculate PV of net subsidy if in the question you are given subsidy. If you are not given subsidized loan, you are going to ignore it. PV of net subsidy. I like to use net subsidy instead of just subsidized loan, so that you don't forget that you are supposed to minus tax, 1 minus tax. Okay, so to calculate PV of net subsidy, there are 4 procedures. The first step is to determine the subsidy amount. So I would then say subsidy amount, SA. How do you calculate subsidy amount? Subsidy amount is the gross finance required multiplied by the proportion of subsidized loan. Proportion of subsidy. According to the question, we have calculated gross finance required to be 22,636. So according to the question, you are told that 80% of the finance required will be through subsidized loan. I think that's the first paragraph. Okay, in the first paragraph, so yes, you are told that the government is excited about the project and has offered AHL a subsidized loan of up to 80% of the investment fund needed at the beginning of the project. Needed at the beginning. At the beginning, so that means before you deduct anything, that means it's a gross amount you are supposed to use. Needed at the beginning, that means you have to use gross amount. So 80% is the proportion of subsidized loan. So multiply by 80%. So SA subsidy amount will then be equal to 18,109. Okay. Step 2 says you should calculate savings on subsidy. Savings on subsidy. So step 2, saving on subsidy in percentage. All right. So the savings on subsidy, when you want to borrow, the amount you are going to borrow in the market will be higher. The interest rate you paid on the loan borrowed in the market will always be higher than the interest rate you will pay on the subsidized loan. Therefore, the difference between the two will give you the savings on subsidy. Okay. So in this case, I would then say savings on subsidy is equal to normal borrowing rates minus the interest rates on the subsidized loan. That is subsidy rates. Okay. So normal borrowing rate, we calculated 7.5%. So let's go and calculate the interest rates on the subsidized loan. So according to the question, in that same paragraph, you are told that 80% of the funds required at the beginning of the project at a rate of 200 basis points below AHES borrowing rate. AHES borrowing rate is 7.5%. 200 basis points is 200 basis points is 2%. Therefore, 2% below 7.5% will give us 5.5. So let's work. You must know how to identify variables and then interpret the question. Okay, let me see. Let me just put it here. Interest rates on subsidy. Can this one be sufficient? Let me use the interest rates on subsidy. SR. Okay. So you are told that the subsidy rate is 200 basis points. So first thing first, 200 basis points. You can see only one question since 200 basis point is 200 divided by 100 multiplied by 100 over 1. This is 2%. So the interest rate on the subsidized loan is 200 basis point below AHES borrowing rates. Borrowing rate is 7.5%. Therefore, SR will then be equal to 7.5% minus 2%. So this will give us, SR will give us 5.5%. Okay, that's the interest rates on subsidy. Okay, so I can then say 5 minus 5. So we have a saving of 2%. SOS is 2%. Now that we have calculated SOS, step 3 says, you should compute net subsidy because of space. Let me just put net subsidy. Okay, net subsidy NS. So to get net subsidy is subsidy amount multiplied by savings on subsidy multiplied by 1 minus tax. Therefore, NS equal to, let me use it because of space. Subsidy amount is 18,109. Savings is 2%. Let me rewrite that multiplication. Then multiply by 1 minus tax. Tax rate is 25%, so we are supposed to account for 75%. So NS will then be equal to 18,109. 18,109 multiplied by 0.02 multiplied by 0.75. You say it's what?
272.
272. So here is 272. 272. So to now get the tax save, the final step, sorry, is to calculate the PV of net subsidy. Because of space, let me use it. This will be equal to PV of net subsidy will then be equal to net subsidy multiplied by annuity factor. All right. So net subsidy is 272. Annuity factor will be, we are using 7.5%. Therefore, 1.075 raised to power 4 years is the useful life of this project. Raised to power 4 minus equal, then minus 1 equal, divided by 0.075 equal 3.349. Annuity factor is 3.349. 3.49. So when you multiply that with, let me differentiate this one. So when you multiply that with 2.72, 272 multiplied by 3.349.
911.
911. So 911 is the PV of ninth subsidy. This is how to calculate the present value of ninth subsidy. Okay, so let's go and post. We're almost there. Wow. One question since. 911. Here is 911. The last one is the PV of tax saved on interest. PV of tax saved on interest. Okay, so let's go and work it out. Working number 15. PV of tax saved on interest. Okay. So to get the PV of tax saved on interest, I gave you 3 procedures. Step 1 is to accumulate all interest elements. Okay, so interest. There's no need for you to say accumulate all interest elements. Just say interest. We have 2 types of interest. Interest on normal borrowing. So we have interest on borrowing. To determine the interest on borrowing, out of the gross finance required of 22,636,000, we are told that 80% is for subsidized loan. It means that the balance of 20% is through normal borrowing. So interest on borrowing will then be 20% of 22,636 multiplied by the interest rate on normal borrowing. Interest rate on normal borrowing is 7.5%. So this will give us the interest expense arising from normal borrowing. Okay. So what do we have?
304.
304. 304. Okay. Again, we have interest on subsidy. So interest on subsidy, if you want to start from the beginning like we did for normal borrowing, no problem. But we already know the subsidy amount to be 18,109. But if you want to start from the beginning, you can say 22,636 multiplied by 80%. So that will give us the subsidy amount multiplied by the interest rate on the subsidy is 5.5%. So what do we have there?
996.
996. Add the 2 together.
1336.
1336. So total interest 1336. So that's the total interest. Now that you have accumulated all interest elements, step 2 says that you should calculate tax saved on interest.
The first interest, is it 304?
I don't know. You are the one that gave me the number. Who gave me the
This is
340.
It's 340.
340? Okay. 340. Maybe the person wanted to say 340. All right then. So tax saved. Tax saved on interest. Okay. How do you determine tax saved on interest? You know, anything that has to do with tax saved, you need to multiply company tax rates. So tax saved equal to, let me put that column there. Open a bracket here, tax saved. So tax saved is equal to total interest multiplied by company tax rate. Please, on the day of your exam, it's not compulsory that you have to be doing all this step by step. For your own understanding, that's what I do this. Ordinarily, if I'm the one solving this, immediately I've gotten my, I've determined my total interest. I will just multiply with company tax rate of 25%. I'll multiply with annuity factor of 3.349. I don't need to be doing it one by one. It's a waste of time on the day of your exam. You don't have that luxury of time. So here is 1336. Company tax rate is 25%. So this one, what do you have here? What's our tax saved? Okay.
334.
334. Did you say 334?
Yes, sir.
So 334 is the tax saved on interest. So after this, you need to multiply with annuity factor. So PV of tax saved will then be equal to the tax saved multiplied by annuity factor. So in this case, PV will then be equal to 334 multiplied by 3.349. 3.349 is the annuity factor. So give it to me. What do you have here?
1118. Okay, 119.
1119. So that's the PV of tax saved. Okay. So I will then come here. PV of tax saved 1119. Okay. So here is 1119. Add everything together. That will give us the PV of financing effect. What do we have here? Yeah. 1. Okay. 1119 plus 911
335.
minus 695. 1335. So financing effect cash flow contributed 1,335,000. Finally, step 3 of our APV is to calculate adjusted present value. Adjusted present value. Okay. So to get the APV, our figures are in thousands. We have calculated base case NPV to be 1060. Then we are going to, since our financing effect is positive, so we are going to add it to the base case NPV. So plus PV of financing effects cash flow, which is 1335. Okay, so we then add the two together. That will be 2395. That's our adjusted present value. Okay, APV is 2395. So examiner is now asking you from the requirements, you have to evaluate on financial ground whether AS should proceed with the project based on the decision rule If APV is positive, then the project is financially viable and should be undertaken. Therefore, our advice should be that the project is financially viable, considering the positive APV of 2,395,000 naira. Therefore, the projects, let me see what examiner is asking them. Whether AL should proceed with the project. Therefore, AL should proceed with the project. Therefore, AL should proceed with the project. All right, so that's that. You pocket it, move to the next one. Now, you cannot earn your full mark on this requirement if you don't state your assumptions. All right, you need to state your assumption for you to be able to earn your full mark. Therefore, even though I'm not sure if examiner is asking you to state assumption, discuss appropriate and discuss. So even it's in the B part, whether examiner asks you or not, is something you must do. In the B part of the question, you have to discuss the appropriateness of the evaluation method used and explain the assumption made in part A. What are the appropriate? What do you mean by appropriateness of the method used? You have used APV. Examiner is simply asking you to explain what is APV. When do you use APV? That's all. That's all. Then you now state your assumption. What are the underlying assumptions? All relevant assumptions you have made. I've told you, anytime you want to state your assumption, you have to talk about cash flow. You talk about cost of capital. If you have inflation in the question, you talk about inflation. Okay? Then any other assumptions you have made. In this question, we also have centrally allocated fixed overhead of 60%. So you talk about that fixed overhead. Again, not only that, let me check the question. According to the question, you are also given the feasibility study cost. We are told that a feasibility study commissioned by the director at a cost of 5 million naira. That 5 million naira, we ignore it. Why did you ignore it? So you need to talk about it, that is a sunk cost. Not only that, according to this question, we also have other information, okay? We also have other information. You can talk about business risk, okay? Or you talk about we use information of a proxy company, okay? We use information of a cost of equity of a proxy company. So all of these things, you need to comment on it. Let me see. Let me stop sharing this and so quickly within the next 1 minute. This is where we are going to stop. In our next class, we are going to risk and uncertainty by the grace of God. Before we close the class for today, let me show you. Let me open to Golden Book. Stop sharing. Let me open to Golden Book and show you what you are supposed to do in that number B requirements. Let me open it. Sure. Okay. Get out. APV, what's the name of the company? Okay, this is the question. Yeah. Let me go to the C part and see how we treated. Aha. So that number B, this is my response to the number B. Examiner is asking you, according to the question, examiner is asking you to discuss the appropriateness of the evaluation method used and explain the assumptions made in part A. All right. So to answer that, I said the APV method is a technique that separates cash flow from operation from cash flow arising from financing and appraise each independently. The relevant cash flow from operation were discounted using cost of equity loan geared in arriving at the base case NPV, whereas cash flow arising from financing were discounted using the borrowing rate of 7.5%, consistent with the M&M preposition. Therefore, the benefit arising from financing effects cash flow of 1,335,000 was added to the base case NPV of 1,060,000 in arriving at the adjusted present value calculation. So that is the appropriateness of the method of evaluation. So in this question, then assumptions. What are the underlying assumptions? These are the assumptions I have made. The analysis of the APV calculation was based on the following assumption. We talk about cash flow. You already know this is not the first time we'll be talking about assumption on cash flow. In any case, it is assumed that all cash flow estimates are realistic and will occur at the end of each year. All relevant cash flows have been inflated at the appropriate inflation rate. So we are given different inflation rate for selling price, variable cost, and fixed cost. We inflate them at the specific inflation rate given to us. Then number two, discount rates of financing affect cash flow. Okay, this is another assumption that we made. Discount rates arising from financing effect. So borrowing rates of 7.5% was assumed as the discount rate for financing effect cash flow, consistent with the M&M preposition. Like I told you, M&M are the two controversial guys that develop adjusted present value, and they fail to tell us the borrowing rate to be used for appraising cash flow arising from financing effect. Therefore, you are at liberty to either assume cost of borrowing, to either use borrowing rates or risk-free rate of return. So according to based on our own calculation, we assume the borrowing rates as our discount rates. Okay. Then number three, working capital. What are the assumptions we made on the working capital? It's assumed that working capital is part of the finance required at the beginning of the project. At the beginning of the project, the company, after considering all the issue costs, the company received the total initial outlay of 21 million. All right. Our assumption is that working capital is part of that, the net amount received at the beginning. So which is, that's what I'm trying to explain here, that, okay, finance, it is assumed that working capital is part of the finance required at the beginning of the project, and that any increase in working capital will be financed from the cash flow generated by the project. Any cash flow generated by the project will be used after year one. Any working capital incurred will be financed with the cash flow generated by the project, which is consistent with what I explained to you earlier today. Now, not only that, this can be tested. Okay, so that's just an addition. That's just an addition to that. If you want to confirm, we can use sensitivity analysis or sensitivity margin, okay, to ascertain the extent to which the NPV can accommodate any change in working capital. Okay. All right, then number four, we talk about cost of capital. What do you mean by cost of capital? The existing discount rate of 12% of Alcantara Limited cannot be used to appraise the new project. This is because cost of capital should be consistent with the project risk and then the cash flow. Since debt equity proportion of Alcantara Limited will change significantly as a result of undertaking the project, a new cost of capital that is appropriate has been calculated using information of the comparable company, that is Cascale Limited. Cascale is the proxy company. Okay, so that's our assumption on the cost of capital. Therefore, the cost of equity, the cost of capital we have computed, which is 10%, is assumed to be appropriate and consistent with the risk associated with this project. Okay, then number five is Yeah, 5-year government debt yield, okay? Cost of borrowing, that is the interest rate, is not given for the bond. You remember, for the proxy company, the bond of 40 million naira, we are not given cost of debt for it. What did we do? We assumed the borrowing, we assumed the risk-free rate of return as the as our cost of debt. So that's what I'm trying to say here. All right, that cost of borrowing is not given for bonds of 40 million naira for Cascade Limited. Therefore, the 5-year government debt yield rate, that is the risk-free rate of return of 4.5%, is assumed as the cost of debt. Okay, that's our assumption on that. You can see the many assumptions I put in this question, about 10 of them. All right, if you do like 5, you are good to go. All right. Then feasibility study. The cost incurred on feasibility study of 5 million naira is a sunk cost and therefore not relevant to the calculation. Then number 7, we talk about fixed overhead. The 60% of 3.5 million naira attributable to centrally allocated fixed overhead was ignored because it's an apportionment and not relevant to the calculation. Only 40% of the only 40% of the fixed overhead were included in the calculation. Okay. Then number 8, inflation. All relevant cash flows were inflated at the appropriate specific inflation rate, and it is assumed that inflation rate will not change for the foreseeable future. Otherwise, the decision to accept the project may change. All right, because if your inflation rate on variable cost and then the fixed overhead increases, then if the inflation rate on fixed overhead and the variable cost increase, that means the decision to accept this project may be affected. All right. So as a result, our assumption is that inflation will remain constant within the relevant range. Then number 9, we talk about scrap value. Okay. We are given scrap value of 24 million naira for the project. What's our assumption? Okay, it is assumed that the cash flow of 24 million naira arising from the sale of the project to a group of young investors is appropriate and realistic. It means that 24 million naira will be earned through the disposal of the project. It will be earned. That's our assumption. Hence, if the sales proceed is reduced by more than 6.5%, that means I need to go and calculate the sensitivity margin of scrap value, because what I'm trying to explain here is that if you dispose, if our assumption is that once the project is completed, it will be sold to a group of young investors for 24 million naira. So our assumption now is that 24 million naira will be earned after year 4. But what if the 24 million naira drop by a specific percentage? Can the project still be valid? That's why, because it is this 24 million naira that is making the NPV, to be that huge, to be 1,060,000. All right, to be 1,060,000. Because this, you can see the initial the scrap value is huge. So what if the company did not achieve that 24 million naira? That means our decision to even accept the project will not occur. So that means we will likely reject the project. And that's why we are saying here that, okay, for us to be able to know the percentage to which the scrap value can fall, I need to go and calculate the sensitivity margin. So hence, if the sales proceed is reduced by more than this 6.5% is the sensitivity margin I calculated here. When we get to call risk and uncertainty, I will show you how to calculate sensitivity margin in more details. All right. So that is as per that, and the company will rely on the benefit arising from financing effects from its for its acceptability. Okay. Then the last one talk about gross finance required. Okay, talk about gross finance required. Present value of issue cost, subsidized loan, and tax saved on interest were calculated on the basis of gross finance required. It's also assumed that tax sheet will arise from issue cost in year 1. This is what I'm trying to tell you. You know, uh, we have used gross finance required for the cash flow arising from financing effects. So if you have used net finance required, the same way I have stated it is the same way you are going to state it, that net finance required is used for cash flow arising from subsidized loan and tax saved on interest. But in our own case, we use the gross finance required because you must tell the examiner how you have come about your numbers. All right, not just doing you have to show, you have to demonstrate, you have to tell the examiner how you have arrived at your number. That's essence of these assumptions. Okay, because examiner may be thinking of something else. You may even have a better approach to solving the question than even what examiner is thinking about, because there is no one way of solving the problem. There are different alternative solution. All right, so you may have a well simplified solution to the problem. All right, but what is important is that you just have to let the examiner know how you come about your numbers. Aisha, what happened to you? Is it time or what? This one, what's the meaning of this? You are crying. Kilo share. Aisha, what happened? Talk to me.
It is well.
All right. So that is as per the assumptions. The last thing we are going to talk about in the question, the examiner has you to explain the ethical issues. All right. What are the ethical issues that, let me see, provide examples of ethical issues that may affect capital investment decision and discuss importance of such issues for strategic financial management. So based on this question, what are the ethical issues? So you can just go through this because of time. Let me just read about 2 lines. All right. The ethics impact many aspects of investing decision. All right. In theory, company may seek to maximize shareholders' wealth, which is often subject to constraining secondary objective, because the primary purpose of every organization is to maximize the owner's equity value. All right. So because focus is on the maximization of shareholders' wealth. Other objective of the questions, other objective of the organization may not be paying the company may not pay too much attention to them. That's what I'm trying to say here. Because we make other objectives as secondary. So such secondary objectives include the welfare of the public. Companies are affected by ethical standards relating to one, health and safety in relation to projects. When you are embarking on capital budgets, on capital budgeting decision. So when the project is being developed, you need to consider the health and safety of the workers. Okay, health and safety of the work, not only the workers. What about the safety of the equipment on site? You also need to consider the safety of all of that. So employees and public should be protected from danger, which include working condition, effective employment law, and product safety. So all of these are some of the ethical issues that we need to consider in capital investment. The second one, what are the environmental issues, including controlling pollution? All right. When you are constructing a project, you may likely use generator. That generator may be making noise. It will be generating pollution through noise. Okay. It may be emitting smoke. That's also that may result to hazard. So then protecting wildlife and countryside. Fully satisfying these issues may be an expensive element in a capital investment. Okay. So because by the time you begin to protect, to ensure that, okay, maybe you want to consider sustainability, you want to take into consideration the sustainability impact of the project, to say that, okay, instead of using generator, can we use solar or all those green energy and all of that? By the time you do, your cost will be increasing. And then once the cost of the project increase, then of course you have to shift the burden to the final consumer and all of that. So again, you need to consider the environmental issues arising from pollution and the need to protect wildlife that within the environment of the project. Then the next item I talk about here is bribery. Okay, bribes and other payments. When you are constructing a project, depending on the size of the project and the need to engage government officials, all right, especially if you are relating with politicians. So there's likelihood that there's likelihood that you may bribe somebody for you to be able to get your way. Maybe you are seeking for license or permit, and then the officials are being stubborn. They are not giving you a leeway, kind of. Okay, you may need to shake body. You need to shake body before you get what you are looking for. When you say shake body, it means that you drop something. You have to drop something for you to see the pathway to that thing you are looking for. So bribery and other payments. So what do you mean by this? Investment might proceed more quickly and efficiently if bribes, the incentive payments, or gifts are paid to officials. Something. Just pray that you don't have issue with any government official where you are looking for something. All right. Intentionally, say for example, now you want to import something from abroad, and then your goods have landed in the port. Something that you can just within 5 minutes, that approval you are looking for is just to put pen to paper and get the approval. They will delay you. They'll be throwing you up and down. Go to one department, go and be looking for a signature that does not arise. You can spend days still looking for still trying to get the approval. In the process, your goods may enter the demurrage. So you begin to pay demurrage for number of days that your goods are in the port. So, but if you have shake body, you have dropped something. You have dropped something to the official. In fact, what you don't want, they are going to give it to you quickly. In no time, you go what you want, you get what you want, and you move on. Next time, if you are coming to that same environment, they know that, oh, this guy normally drops something. Let's treat him well. But if you are trying to be too wise, you don't, they drop shishi. You're on your own. Because they drop shishi. So all of these things is part of ethical issues that you need to consider. All right. Even though in your corporate governance, okay, you don't settle, you don't bribe, you don't do this. Hey, behind the scene, things are happening, because otherwise they are going to frustrate you. They are going to frustrate you. Dangote was telling us that he initially wanted to site the refinery somewhere. Is it from the south before he came back to Ogun, then from Ogun to Lagos? Why all of these things? Something money must exchange hands. All right. But in any case, that's for another day. Okay. So what we are saying here is that there may be in relation to project, because you are going to need approval from the government. If, for example, you want to get CO4, that CO4 will not come with ease. You can't just go there and get it one time. It takes process. But if you want it faster, then you need to settle somebody to get it to make it happen as quickly as possible. So that bribery and other payment or incentive you are going to give to government official is an ethical issue. All right, it's an ethical issue. So this is a difficult area, as gifts are part of the business culture in some countries. Okay, even the ethics of political contribution is debatable in some organizations, because it's part of their corporate governance that you don't contribute any money to political campaign, or maybe you have a candidate as a company, say, okay, let's donate money to a particular candidate. All right, you don't do that. It's an ethical issue. All right, and that's why some companies, they have it in their corporate governance or in their standard of business conduct that you don't do that. You don't give donation to any political candidate. Okay. Then about next, I talk about corporate governance. Many examples exist of companies, e.g. Enron, where the result of investment and the true financial position have been hidden from shareholders and the public. Of course, there are so many ethical issues relating to corporate governance failure. All right, corporate governance failure or management oversight or board oversight. All of these things, there are issues relating to the project that you must consider. Then taxation. Company may try to minimize their tax liability. Tax evasion is illegal, but there is an ethical question over sophisticated tax avoidance measure, especially in developing countries. Okay, you are doing tax, so what under transfer pricing, how you can hide under transfer pricing to change government, okay, in relation to your tax liability. Then wage levels. Should a company pay low wages to maximize shareholders' wealth, especially in countries where the standard of living is very low? All right. So it also depends. All right. If you want to maximize, because you are seeking to maximize shareholders' wealth, you're trying to be cutting costs, and then the employee that are supposed to pay livable wage, you are paying them below the minimum standard. As a result, they won't do the job very well, even though you are trying to increase to maximize your revenue or to maximize profits. Okay. Then lastly, I talk about individual management ethics, the ethics of individuals, including pursuing their own goals and self-interest, such as job security rather than those of organization, might influence the outcome of investing decision. Because some of the managers, what we call about agency theory, stakeholder theories, and all of that. Some of the manager, because maybe, for example, the company have given them share options, and as a result, based on their performance, based on achieving certain conditions. So because they want to meet up with that target, all right. So they may want to be, because of what they are going to benefit from meeting the target, then they may want to do something that is not ethical as a result of achieving their results. So these are some of the ethical issues we consider in relation to investing decision. There's inevitably some of subjectivity as to what constitutes ethical behavior, but there is little doubt that ethical issues are of increasing importance to companies. Acting in an ethically responsible way often has a direct detrimental impact upon expected cash flows and the net present value. However, stakeholders, including shareholders, are increasingly expecting companies to act ethically. If they do not, then their share price might suffer as a result of adverse publicity and investors withdrawing their support. So these are the ethical issues that we talked about, and that's the end of the question. That's the end of the question. So like I said, in our next class, by the grace of God, we are going to we are going to uh, we are going to discuss risk and uncertainty. Okay, we are going to discuss risk and uncertainty. Let me know if you have any question for me so that we can close the class. All right, only one question since. It is well. Aisha, it is well. Okay. Any question for me? All right. So in the absence of no further question, this is where we are going to call it a day. But I want to advise you, please, go and solve as many questions, go on and try as many questions as possible under adjusted present value. Like I told you, the last time ICAN tested this was in 2019. Ever since then, we've been anticipating APV. So you never can tell if it will come out this diet. Therefore, there are different scenarios that can occur under APV. At times, examiner can give you questions that involve debt and equity. This particular question is just debt alone. It is possible you may have debt and equity. All right. So you need to go and try that too. Not only that, it is also possible you may want to calculate your PV of financing effect using the net finance require. How do you treat it? So try and look for several illustrations that you can lay your hand on, so to gain more insights on how to calculate adjusted present value. So in this material, I have about 4 or 5 different illustrations that you can practice for those of you that have it. When you go to ICAN find that I think there are just I think maybe 2 times that ICAN has tested this. But again, ICAN has never tested any question relating to debt and equity when you are calculating issue cost. So, but in this material, you have example of that. So try as much as possible to go through them. Go through them. How do you treat it when you have debt and equity? How do you treat? So I've already explained to you how you are going to treat it, but the application is what you are going to see in the material. So then the illustration number 1 in your study material, that one I use net finance require. I use net finance require. So how do you treat it? This is the same question you have here, net finance require. So try as much as possible to go through the solution too, so that if you use net finance require, how do you treat it? So I demonstrated that. So that will be the end of today's class, guys. I will see you next time by the grace of God. Good night, everyone. Okay.
Thank you, sir. Good night.
Yeah, Minister of Finance. Good night. Okay.